must avoid stocks that show subtle red flags which scream bad decisions. Investing at a young age is crucial if you want to achieve your long-term financial goals. Don't you think you should pick an investment with the potential to offer returns over inflation consistently to get to your goals? Well, if you are a youngster or millennial looking for a suitable investment to get to your long-term financial goals, you must watch this video. After all, the secret to investing is to figure out the value of something and then pay a lot less, as Joel Greenblatt has told already. Hello and welcome. I am Prarthana from Clio, which is India's largest tax and financial services platform. At Clio, we have assisted 6 million plus tax filers so far. By the way, I have an exciting announcement for new subscribers. We have curated 4 of our best calculators that will help you estimate the future cost of your financial goals as well as identify the lump sum that you need to invest to reach those goals. Well, to claim it, subscribe to our channel and let us know in the form that is provided in the description box below. Now, what are we waiting for? Let's get started. A stock is a type of investment that gives its holders a share of ownership in a company. In simpler terms, you are a part owner of a company when you buy its stocks. When you buy stocks of a company, you are entitled to certain privileges, such as you could have the right to vote at a company's annual shareholders meeting. If the company distributes dividends to shareholders out of its profits, you get them as well. If the company's stock price goes up, then you get profits. However, if the stock price declines, then you have to suffer a loss. Many people fear stocks because they believe that they could suffer heavy losses if the stock price falls. According to top investors, investing in stocks is extremely risky if you don't know what you are doing. Sadly, many people suffer losses in stocks because they behave as traders. Experts say you should invest in stocks for the long term if you want to achieve your financial goals. Otherwise, you could suffer losses with stock investments as the stock market is very volatile in the short run. Many people make another big mistake when investing in stocks. Well, they choose the wrong stocks and no matter how long they stay invested, they may never reach their financial goals. This is why you must pay attention to red flags or warning signs that say you have invested in the wrong stock. Let's take a look at the subtle red flags that scream bad decisions, which simply means that you are invested in the wrong stocks. One of the biggest red flags is owning stocks of companies with unstable earnings. Firstly, if a company's earnings are volatile, then expect its stocks to follow up soon. Secondly, invest in stocks of companies where revenues are growing consistently and profits are good. Then pick stocks of companies with annual earnings growth rate of 20% to 25% over 3 to 5 years. The key takeaway is to pick stocks of companies whose revenues and profits are growing consistently. There are many companies that leverage or use debts to grow and expand their businesses. However, a company with too much of debt on its balance sheet is definitely a liability. You must avoid stocks of such companies because, firstly, companies with too much of debt could struggle to service their interest payments on loans and cover daily operating expenses. Secondly, as a company takes on too much of debt, chances of a default increases, especially if it is struggling to make profits. Thirdly, you must check the debt to equity ratio of the company, which shows you the company's debt relative to its net assets. Fourthly, if you invest in stocks of companies with a very high debt to equity ratio, it is a risky investment. Fifth, While some amount of debt is acceptable, companies with increasing debt to equity ratios are financing the expansion of the business through debt, which of course is risky. Wondering how to calculate the company's debt to equity ratio? Let's find out. Firstly, to calculate the company's debt to equity ratio, you need the company's total liabilities and its shareholders' equity, which you can get from the balance sheet. Then divide the company's total liabilities by the shareholder equity and you get the equity to debt, or rather the debt to equity ratio. The key takeaway is the ideal debt to equity ratio is around, while companies with debt to equity ratio below 1 are relatively safer, those with debt to equity ratio above 2 are risky. I hope by now you have understood some of the subtle red flags in stocks. Don't you think that you should know more red flags in stocks so you can save your money and build wealth over time? If you agree to this, then please type yes in the comment section below. You must stay far away from the stocks of companies with poor corporate governance. Consider poor corporate governance as a very big red flag. It's basically how well the top management runs the business, and you don't want a poor score there. Firstly, the top management decides the fate of the company. Then look for signs of unethical business practices, attempts to influence stock prices, and manipulation of financial statements. Then just imagine a company with several complaints from customers against their products and services. Do you want to own stocks of such companies? What about a company that treats its employees badly and does not care for their welfare? Well, the key takeaway is pick stocks of companies with competent management and leadership with a focus on people, purpose, process, and performance. You must invest in stocks of companies that are on the path to innovation and development. If a company is not releasing new products and services, it is a sign of stagnation. Firstly, if a company is not developing products and does not have any positive news around it, the stock price will not go up. If a company is cutting jobs heavily, it is a bad sign and a downfall is definitely near. You must check if the promoter is buying more stocks of the company. It may show that the company has good growth prospects and the promoter is confident of the business. Firstly, promoters are usually the biggest shareholders in the business and understand the company well. Secondly, if the promoter is increasing the stake in the business, it is usually a good sign. While promoters trimming or reducing stake in the business is not necessarily a bad thing, it does convey a subtle red flag. You must find the reason why the promoter is reducing stake in the company. If the promoter is pledging shares of the company, it is a big red flag. It is basically taking a loan against shares, and promoters resort to this option as the last resort. Well, the key takeaway is if the promoter has pledged a significant percentage of stock of the company, you must find out why. It is best to avoid stocks of such companies as prices can be volatile. You must check if the company whose stock you hold has major lawsuits against it. Litigation can impact the brand image of the company. A lawsuit against the company can result in poor sales and negative brand image. Secondly, you have a top automobile company involved in an emission scandal or a big FMCG firm having lead in one of its major food products. Companies may have lawsuits filed against them because of faulty products or for being involved in a major scandal. If the lawsuit of the company gets major media coverage, then the public will soon know about it. This will result in the stock price crashing, especially if the lawsuit could hurt the company financially. Well, what is the key takeaway? And that is, lawsuits can have a major impact on the company's profits. If a company has a big lawsuit threatening its brand image, then it is best to stay far from its stocks. You must avoid stocks with subtle red flags that scream bad decision if you want to build wealth in the long run. Otherwise, you could suffer huge losses and lose a lot of money if you choose to ignore these red flags. Received some valuable information through this video? If yes, then do not forget to subscribe to our channel, and you also have to subscribe to claim your free gift where we have curated 4 of our best calculators. Also give this video a big thumbs up and share it with your friends who might find it information. And to claim the gift, subscribe to our channel and let us know in the form that is provided in the description box below. Thank you so much for watching the video. Take care.